This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this monthly market and economic update. In this video, we'll discuss how markets and the economy fared in February and what the key takeaways are for investors. Now, markets declined in February amid tech sector weakness, with the Magnificent Seven dropping 8.1%. The new Trump administration's tariff policies sparked investor concerns, and inflation worries have also risen. Major indices posted losses, with the S&P 500 being down 1.4%, the NASDAQ was 4% lower, and the Dow Jones was 1.6% lower, while bonds gained 2.2% and provided portfolio stability. However, it's important to remember that markets also made all-time highs during the month. Thus, the losses felt by investors could actually be greater. So it's important to keep these recent moves in perspective. We'll spend the next few minutes discussing these themes in more detail. First, this chart shows the annual total returns for different asset classes. The S&P 500 is lower because the Magnificent Seven tech stocks have faced challenges despite positive AI developments, while defensive sectors like healthcare, financials, and consumer staples led market gains. Meanwhile, bond markets performed positively as the 10-year yield fell to 4.2%, providing portfolio balance during stock market volatility. Now, international stocks have also performed well this year across developed and emerging markets. Many of these asset classes have outperformed the S&P 500 year to date, highlighting the importance of portfolio diversification. Next, as this chart shows, consumer expectations for inflation have risen significantly, with 12-month projections increasing from 3.3% to 4.3%, and 5-year expectations reaching 3.5%. Other data show that inflation has returned to 3% according to the Consumer Price Index, with food and shelter prices remaining elevated. Now, the fear that inflation could reaccelerate is resulting in market volatility and uncertainty around the Federal Reserve policy decisions. Hotter inflation means the Fed would keep rates higher for longer, which is typically not what the market prefers. Once again, it's important to keep these numbers in perspective. While inflation is not back to the Fed's 2% target, it is still far lower than what it was in 2022 and 2023. Inflation concerns will likely drive market swings, so investors should be prepared, as always. Finally, this chart shows the S&P 500 index alongside its trailing 12-month earnings per share. Earnings tend to track economic growth, and when earnings rise, investors are typically willing to pay more per share, leading the markets to rise as well. Now, recent corporate earnings show robust growth, with an 18.2% year-over-year increase in the fourth quarter of 2024, the highest since 2021, with 75% of companies exceeding estimates. The S&P 500 earnings per share are projected to reach $266 this year, representing 12% growth. Now, despite market volatility from various factors, strong corporate earnings remain a fundamental driver of long-term market performance. Investors benefit from maintaining discipline as conditions evolve across economic factors, technology developments, and other variables. Volatility is an inherent part of investing, but history shows that maintaining a truly balanced portfolio, as well as long-term perspective, is the best way to achieve results over longer periods of time. I hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our eye-opening white paper titled Busting 7 Risk and Return Myths. You can click on the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you are an individual investor We are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.